On, ladies and gentlemen. So today I want to get into something that's actually not about how I think the stock market will probably be moving, though I do have some really interesting ideas about it. Actually, the news about the currencies, all these things that are going on with the trade deal, it's it's freaking awesome, and we're gonna probably see some crazy stuff I think happening. We're probably gonna see a rally if these currencies actually work out. I do want to actually do a whole separate I think video and discussion on that. But for the time being, I actually want to get into how to deal with a shitty credit spread. So I'm not actually the one who figured this out. It's my friend who's right next to me, who I've traded with forever with at this point. Basically, what happened was some time ago. Do you remember the date?
Yes, I do. It was 10-4.
Okay, so October. This is the 7th.
10-7.
Okay, so October 7th, Apple had hit 229 that day, right?
Yes.
230. So he was telling me that he doesn't think that Apple can hit 230. There's just like no way that it can hit 232, and I like vehemently just disagreed with him on this. I was like, no, I think it can, and he's like, no, I don't think so, and the reason my reasoning was back about a year ago when AMD was taking off from $15. No one really thought it could go any higher, and then it just did. Yeah, I'm not in the mood to actually go back too far on that. But, it did. It went from 15 all the way to 32. And then, Intel came out with their news, and then they tanked. So that's a different story. I think I'll talk about that later. But for the time being, what ended up happening was he was very close on this position. And so the way that worked out was you purchased it on the 7th of October.
So here's what happened. So
Yeah.
I purchased it. What I did is actually I executed on a credit spread. So that
So
means
you were
that,
selling the call side. What were your strikes were
So my strikes were 230, 250, and 235.
So which
And
one were
on
you?
the
You were
next-
selling you were selling the 230 250 and you bought the 235s.
Right.
Okay.
So it's a credit spread on that two strikes. I sold the 232, bought
Right.
the 235. Next day, I actually instantly that day I had made 50%, and then the next day I had made almost 80%, and I made a few order days.
Additionally.
What?
Nothing. I was just joking. Yeah, go on.
And so what I should have done actually was gone out of there, right?
At that
because
point, yeah.
I had about $20 of credit that I could wait and let, sit to zero, hopefully during that time.
Right.
But I didn't let that happen, and I got a little bit too greedy, and my orders wouldn't go through. So I held it throughout the week in order to go through what happened today, actually, which was
let's go
breaking
into the
through my
intraday.
strike price.
Okay, so Jesus, I forgot about this.
Just maximize it.
So basically, this was yesterday, and so we were here. You were safe. You were safe as of the close on this day. For the most part, there was just no way that it was going to climb another $5,
Right.
or we didn't think it would at least.
Right.
Yeah, that's here. So and then today, so this was fine. You lost what some amount on this day.
I lost about, I'd say, I actually lost 200% because the credit had gotten from 10 or like from 15
Yeah.
to 40. So that means that it went up to 30 and then 40, right?
Oh,
So
yeah.
technically
You,
it was
you bled into
because
the collateral. Right.
Well, no, not that.
Not yet?
But it was the credit that had made 200%.
Mm-hmm.
So I had technically lost, $20 from that. So
If you had repurchased it at that area,
I
that's
mean,
what
you know
your
how
position-
Robinhood works. It works from the day before, and then it goes to the next. That's why it's 200%.
I actually didn't know that it did that.
Yeah.
Okay, well, either way, this you and I actually got in an argument that you thought you were pretty bearish on the market. I was like all of a sudden really bullish on the market just based on this whole recovery and then the trade deal and then the talk about the currencies. And then lo and behold, the market actually takes off quite a bit. What, we moved like 1% overnight? Probably not. Seems like a bit high. Oh, yeah, okay, 1% overnight. So we moved 1% overnight. And, okay, what happened here?
So now at this point, I'm losing on my credit spread, right? It's Friday, and that's when you know that your option can either make it to zero or really take off.
Right.
And so now my strike sell, which is in the blue right here, is what I was selling, right? The thing that is first to hit. And so my
So
sell
this is bad.
instantly
Well, as soon as it
went
crossed this, it was bad.
right, because I expected that this strike would go to zero, but now
Right.
that it has intrinsic value since it's going in the money, right? And so now I'm facing, I think, a $50 loss at that point, and I had one of two decisions to make, and I had made this right in the morning, and I had sold my sell, meaning I bought to close at
So
this
you
point.
you bought your sell back.
So exactly. So my credit spread, which I had been holding throughout the week, I finally ended it, and I had bought back the leg that I had sold right at this point when I saw that it was breaking the pre-market highs here. In which case, afterwards, it just went and rocketed throughout the day.
All you had left, you had your 235 put, which actually ended up becoming like way in the money.
Exactly. So exactly right here. This. So I'll just mark it here for you can see it right here that it's the 235 right here. And so this 235 this whole time so when it went through here, it was about 40 cents when it started for the day.
Yeah.
Going through here, it hit about, I'd say 55, 60. Went through here, and even here it went and hit 65 and 70. You could see the theta really work against you. And then you go back here and you see that it's 49 and stuff like that. And so I sold actually around this point because my mentality was like, okay, it's Friday.
You were trying to recover the loss from the sell.
Exactly. And so I wasn't too keen on holding throughout the whole day. But, it held its value, and you can see what happened.
Well, the way it overheld its value, I think the thing hit, it hit like 500% from here to here, because 50 to, 250?
Yes,
something like that?
exactly, yeah.
So it was pretty...
Pretty nutty.
Pretty, yeah. I mean, okay, so, but I think the lesson to take away from that is the way that you position yourself in certain things, you can actually keep holding and just switching around and playing around with the legs. Because you did something, was it with Roku or Tilray?
It was with...
Something where you made a certain amount and then you flipped it, and you held only a call or put. Oh, Beyond. Right?
Right.
Beyond? Okay, so let's do the Beyond play.
Right.
So, do you remember the dates?
Well, I remember being super ecstatic because I had made it literally with 3 months of time. And so my expiry date was
November 29th, right?
It's still actually
You still have it.
November 29th. And 3 months before, so this was around in August actually.
Okay.
So during this month, when it had broken through these critical levels of 160,
You were selling puts.
I bought a put. I put debit spread, and what I had done is I bought a put debit spread for November.
Okay.
And I had bought a 60 strike price for $60,
Which is super. It's just like you have to lose 50% even now to get that.
Exactly.
Which is kind of
so.
far.
I actually bought
like
a
way too far.
60 strike price for $60. I don't think that it'll hit it, but at least if it can get close to 100, that thing will be valuable. And so, 60 for 60 strike, and then I had actually sold a 55 strike for $60. So I had waited and timed my buys and sells properly so that I would risk zero.
Okay, well, let's explain it. Let's try to explain it on the chart, because even I'm confused.
Oh, okay.
Okay, so like right here you bought a debit spread, right?
Right.
On the puts.
Yes.
So as it went down, you would increase the spread would increase the value, right?
Right.
And then what happened?
So this had gone down, right?
Right.
And
that was good for you. You made like 40 on that, right?
No, I had used my profits from the 60 since I timed it differently, right?
Okay.
Because I had sold a strike below mine for an equal price that I bought the upper price, right? The upper strike.
Okay.
If that doesn't that I
I'm
said
so
that
confused.
oddly.
I'm so confused.
So
just tell me the numbers.
I made the play free, like Josh says. I made the play free, and so what I did actually is I waited throughout the day, throughout these days actually, and throughout this time, this strike difference actually went to like $20 and $25.
Okay.
And so I had made a lot on my sell, and I lost a lot on my buy. So they had both equally gone down, but I still made some on my sell. And during these past 3 days, I reasoned that I had $20 of credit and debit
Uh-huh.
in those two strikes, right?
Okay.
And so I'm sort of reasoning that, okay, I don't need to get back that $20 that I'm selling. So I'm just going to buy it to close, and I'll let that 20 run, especially when it's hitting these critical levels right here, when it might break down even below, because 130 is an insane level, right? Below that, it's just 100 and so on and so forth. And so that's a pretty smart move on my part, because there's
Okay.
real potential.
So the way that you're playing these, worst timing ever. The way you're playing these is by basically you're purchasing the legs independently.
Yes.
So basically, like, for example, if it's going down and you have so say we're right here and we buy a debit spread.
Right.
We'll buy a debit spread and we'll make some difference on the spread increase from this drop, okay? But then say it takes support right here, for example, and then the market starts coming, or not the market, but at least the stock itself starts coming up.
Right.
Okay? And that's not doing too well. Your put's not doing too well. So what you can do, and what you've done, I don't think specifically for Beyond, but I remember that you've done it, which is I thought that was really clever because somehow you turned plays that weren't winning into winning ones. So what he did was, at one point he would sell. He would hold. So he's holding a debit spread on the put side, which means right around here, when it starts taking off, he's gonna lose that spread. So what he would do is he would get rid of his what was it? Your sell, your buy. So okay, because you're holding, you'd get rid of your lower sell, and you would basically flip it and turn it into a credit spread. He flipped it, turned it into a credit spread. Once it hits the critical levels again, then he just held it as a naked put, and it's been going up since then. So like today, it made like 50 or
it made about almost 100%. Actually, it went from 20 to 49.
So more than 100% then, right?
Yeah.
So so that's actually pretty effective, that method that we found out. So for example, when I played a Facebook credit spread against 180, and I bought that about a week ago. So where was it? We were here, I want to say. Let me actually find the exact date. Hold on. So the Facebook credit spread that was rolled over, and this is on, I think this is on Josh's stream, the one that he did. So he bought like a credit spread. I'm trying to remember when the exact date was, because I don't remember it. This is the Apple Iron Condor. All right, whatever it was basically a put against whatever last Friday was. So so he had it on last Friday, but then what happened was the next day it fully recovered. It fully recovered back, and because the strikes were 177 and 177.5 and 180, and it started going negative. So what I ended up doing was I sold I closed out actually the whole thing when I saw that it kind of took a support, but then it came back up, and then the next day, basically the position was in a way where it actually had to be rolled over, and so what I did after that is I actually purchased the position again in the following week, and I kind of rode that back down, and then I sold splits of it, parts of it, and so I wrote it for shorter periods, and the point of these spreads is technically you ride it to expiration, because that's where the majority of that's how you get 100% of your original investment back, despite the collateral. And I don't know, selling legs by legs, selling and buying the legs was actually really effective. So, I mean, I guess we didn't explain about doing this, but essentially, I think one thing that is really effective, for example, if you can find that this down run is kind of running, you find news, you have whatever pieces of information, you say, okay, I don't want to deal with theta necessarily, especially in a market like this. I don't know what to expect entirely. So you take a debit spread. You take a debit spread on the put side, or better yet, and this one will guarantee you the entirety back. You could actually buy. So at this point, you buy a call credit spread. You open up a call credit spread, and you sell it. So you sell the call credit spread here, and you write it back down until that credit spread, the decrease of that credit spread, the selling, is what makes you the majority of the money. And then as soon as you reach the point where you start seeing support start being taken, you sell that, you buy back your sell, and then you flip it. And you either hold it naked or you turn it into a debit spread. And then you can actually gain that back. So you can play it on both ways. And that's actually the really cool thing about splitting the legs up sometimes, is that you can actually play both sides of the same thing. You don't ever actually have to leave, whatever position that you're in, which means you can track the moves. And that's kind of an interesting fact, is that every option that you're in kind of has its own, behavior, right? You figure out how it reacts. That's why we purchase them, to suss them out. So, you ride this wave down, and then you see, okay, this thing is priced it in at this point. I could probably sell it. Okay, this day comes up. You don't want to have to deal with this credit spread going against you any further. And so, you already took it up here, so you are more or less protected. So it's not going to fall in the money again, probably. But sometimes it happens still. Right. And then you could probably actually hold naked calls and actually end up pretty profitable there on that type of exchange. And this warrants you for a stronger move than 100%, depending on how it moved, especially because once you lost all of this credit, or once the option lost all this premium right here, it usually, its buyback is a lot faster. So it gains it back fairly quickly sometimes, especially once it starts moving, right? Because you have some of the Greeks working in your favor. As it starts to gain motion, delta, as you get it, it starts to become easier for it to pick up premium. Mm-hmm. So these moves are actually really good, and breaking apart these credit spreads is a cool way to, I think, kind of stay profitable, because what happened with Apple, which I really thought was awesome, is, all right, so let me think. So this was ultimately, at the end of the day, this was wrong to claim that it wouldn't hit, because it did. And so the cool part about this is basically polishing a turd. Like, you took a play that definitely did not work in your favor, like, whatsoever, and you made it profitable despite the fact that it totally didn't work in your favor. Right. And if you timed it better, if you figured that out, then maybe you could have figured out, oh, hey, maybe you could have actually cashed in way more profit on this part of the game.
Right.
So, for example, you ride it up here, what is it? You were selling the credit spread here of the calls, and then you were trying to take that premium. Once you figure out that, maybe this might actually take off based on whatever market news or whatever, you get rid of that leg, which has already created a cushion, and then ride that up. Either way, though, even once we crossed past into above your strike price, and I think you started actually. Were you in? You didn't bleed into your collateral at all, did you? No, you
no,
did.
I didn't.
You didn't? Okay.
Oh, no, I did.
You did. You definitely
about
did. $50 in.
$50 in, yes.
$50 into your credit? Okay.
Yeah.
But then this move was actually strong enough to where it paid for more than the price of the option and the collateral. It was crazy. And the percentage that it changed by was really good. So if you could have had the wherewithal to actually hold till expiration,
right,
and let it expire in the money, then you would have actually gained back, everything and then some, right? Because the net that you had to make from that credit spread was what? Do you remember? Like 70?
It was 67.
67?
Yes.
So 67 was risked, and you bled into the entirety of that, more or less.
Right. Actually, during these past 3 days, I'd made 50 on it.
Right.
And then I had actually given it all back and then given some more.
Right. And then once you sold it and let it ride, it started actually taking off, and it paid for itself back.
Exactly.
You were able to break totally even on the whole thing.
Right.
But you could have been
flip
profitable.
positions on a crucial day, on day of expiry, and let that work for me.
Yeah. So you basically,
for the most part,
you pushed it to the wall on accident. This might have been luck. I don't know, but it was still a but I can't say it is luck, because you've done it before more than once. So, But yeah, I thought that was really cool, and I feel like I'll probably try to like show it on the channel. Like I'll bring it up, and I'll you know, bring the statements and stuff like that, and I'll walk it through how we would have done it like on demand and stuff like that.
I actually wanted to talk about something else.
Sure.
This is one strategy for turning your credit spreads if they're going against you. If you know when to switch positions, you can buy back to sell and let the other one ride.
Okay.
Another one is Roku. This thing, when it had the drop
Yeah.
from, it was September 18th. So that is this day. Yeah, this day. Yeah, these two bars aren't helpful, but if you're facing the common trouble of having not enough day trades, then you can possibly do this where, I remember on this day I really wanted to trade it and I didn't have enough day trades, but I still went through and bought a put during this downfall, and it is risky because you can't get out, but what you can do is, in order to protect what you have made, you just instantly have to go down a strike price below where you bought it, right? Just the next strike price, and then sell it for the same exact price.
Turn it into a credit spread, yeah.
Or sell or a debit spread. Sell it for what you bought your other strike, right? So
Okay.
you make it like zero loss if both go to expiry, right?
Okay.
So same thing I did with the Beyond. I bought something for 60 and I sold something for 60, but they were at different
right.
strikes.
That's how you made them free. Is
Exactly.
Yeah.
I had used my profits, and what that did was it pretty much encapsulated what I had made, which was about a $50 difference between the strikes.
So you basically, so at the end of the day, if you wanted to do it, you had the spread difference locked in.
Exactly. And then if it still went in my direction, I could still make money because there would be a difference between the debit, and that's how I make
And
money.
these are really useful, I think, for growing accounts, small accounts.
Yeah.
Like what we do is, because we don't have $25,000 just sitting around that we can really throw in like that. So what we do is we take how many accounts do we have? Like 10? We have like 10 different traders accounts, and each one of those accounts has maybe I don't know, like $400 or $500 in it. So it is like 5,000 distributed between all accounts, which is a lot more manageable, and that allows us to grow like these smaller accounts into bigger accounts, and then eventually we can reconcile them and make one big PDT free account. But in the very least, we get some day trades on those, and we actually get to independently create those accounts. So like one account diversify that it's not actually diverse, it's one account, but it helps it be perceived that way to us, and that allows us to, I think, trade it a bit better. Anyway, I think that's all for now. I think what we'll do, I guess in a different one, if you join these videos again, we'll go through like actually like going through the history, and we'll read out like what actually happened and how they
and what
played
time
out. Yeah,
is
timing
so
and stuff
for.
like that.
Yeah.
So that'll be a lot more productive. But thanks for watching. If you watched, if no one watched, then whatever. Bye.